My name is Kier Boley, and I'm the CIO for Alternative Investments at UBP. Welcome to this podcast, which today focuses on hedge fund investing. Specifically, I will look at how you should analyse a hedge fund investment, where we think there are current areas of interest for investors, and finally, how a hedge fund investor should fit within a portfolio. Let's start with how to analyse a hedge fund. The good news is that you should treat them as you do any other asset class. That is, in terms of what is the expected total return over the medium term, what is the volatility or uncertainty surrounding that estimate of expected return, and finally, how does that return profile change in relation to other assets such as bonds and equities. Beginning on the expected return. This can be broken down into three sources or drivers of that return. The first source of return is the manager's alpha or excess return. This is what separates one manager from his peer and why does he or she consistently outperform that peer group. At UBP, it's the core of our bottom-up research, which is focusing on finding high-quality individual funds and managers, as this alpha, or this excess return, is the rarest and so the most valuable component of the three sources of return. The second source of return is generated by investment strategies which they and also their competitors use. It's still of value, but is not unique to the individual fund. We call this hedge fund beta. These factors can compress or expand the opportunity set for the underlying managers. So, for example, the size of the spread between two companies that are going to merge changes over time. So your actual return due to those movements in the spreads can have a big influence over the medium term. The final source of the three returns is the market beta within the hedge fund, and is driven by the direction of underlying markets, and is very similar to the drivers of a long-only manager. What do we like today? Our emphasis is on hedge funds, and where we believe the expected total return will be above the historic trend. Alpha is the most stable component of those three returns, so the variation in the other two sources can actually have the greatest impact on medium-term returns. If I focus today on the second component, which is the hedge fund beta. Looking at the underlying strategies, it means that just working through each one, for fundamental research-driven strategies such as equity long-short, we like sector or style specialists, as the broad-based stock gains that we've seen since March should mean that going forwards, specific company news should have a greater impact on the share price of that company. This means that the managers can make money on both the long and the short side if it's good news or it's negative news. In addition, credit long short, where we have been the most cautious since coming into 2020, now looks attractive, as the differences between credit quality and default rates as the real economy starts up again will have the greatest impact on opportunities. Among strategies that focus on capturing changes in spread, merger arbitrage and corporate restructuring should generate above trends for the next 12 to 18 months. Within the directional strategies such as global macro, the main factors that impact returns in this strategy is carry, momentum or trend, and value. If the manager is focused purely on developed markets like Europe or the US, two of these three factors, carry and value, are minimal, whilst trend remains strong. Therefore, as a team, we prefer managers who opportunistically can move between developed markets, but also into emerging markets where carry and value are also available. This takes us on to the systematic side of alternatives, and our preference is via a rules-based multi-strategy approach that provides diversification, non-correlation, and is cost-efficient. Finally, one area we have been very cautious for the last 7 years due to the low or skimpy expected returns versus the risk you had to take is distressed investing. The expected returns for this investment approach is highly sensitive to wider economic and liquidity cycles. We are now very constructive on the space and will be looking to create a vehicle to capture this opportunity. On to my last section of today's podcast, and this refers to how it should fit within your current asset allocations. We believe that alternatives like hedge funds should be seen as a substitute for specific traditional assets. Therefore, the relative expected returns between the two asset classes should be compared. If a hedge fund's expected return is greater than that of the traditional asset class, then exposure should be switched. One thing to point out, though, is that often this may be because the traditional assets, such as equities and bonds, have had such a strong rally that their current valuations are elevated, and expected returns will therefore suffer a return to mean. Currently, the asset class that is the most obvious candidate for replacement are bonds, given the low level of current yields, and so some form of alternative yield may be a sensible move for investors. I hope my podcast today has provided some food for thought about alternative investments. If you have further inquiries, please contact us at the AIS team or visit the ubp.com website. Thank you for listening.